Good afternoon, everybody. We're just going to wait a few more minutes for a couple more of the attendees to log on before we get started here. So if you want to just bear with us for a few minutes, we'll get started in just a few moments. Looks like a lot of folks are waiting for the last minute to get on here. All right, we'll get started. Good afternoon, everyone. Thank you for joining us today. On behalf of Sax Wealth Advisors, we'd like to welcome you to this webinar, Staying the Course Through COVID-19. We hope that you and everybody around you is doing well and staying healthy during these trying times. My name is Joe Piella. I'm one of the wealth advisors on the Sax team. My co-host today is Jeremy Wren, another wealth advisor on our team. Jeremy, how you doing today?
Good. Hi, everyone.
Today, Jeremy and I will be leading the discussion with our guest panelist, Apollo Lupescu from Dimensional Fund Advisors, who will introduce in a few moments just a few housekeeping items before we get started. For those of you who are joining the webinar that may not be or may be new to Sax Wealth Advisors, we're an independent registered investment advisor, an RIA. We're a wholly owned subsidiary of Sax LLP, multidisciplinary accounting, tax, and advisory firm. We're also members of the NAPFA fee-only network. You can check us out or more about us on our website to learn more about the rest of our team and the work we do with our clients. It's at www.saxwa.com. That's SAXWA.com. You can also find additional COVID-19 resources there for both individuals and businesses, which we are updating with new information as it becomes available. As far as the webinar is concerned, all participants will be muted to avoid background noise and distractions. I've asked my two children to give me some privacy, but with a 5- and 6-year-old, you never know. So I apologize in advance for any distractions on my end. If you have any questions during the webinar for the panelists, please type it into the question box. Only the panelists will be able to see the questions, and we'll be monitoring them throughout the webinar. We'll do our best to answer as many questions that we can during the Q&A portion of the session. Please keep the questions general in nature, as we won't be able to answer questions that are specific to your personal situation. Lastly, this webinar is being recorded. It will be sent out via email in the next 24 to 48 hours, and it will also be posted on our website. So we're in the middle of our 6th week of working remotely, and for my wife and I, we found that it's been both a challenge and a blessing to be working full-time from home while at the same time attempting to homeschool our two children. And although I grew up in a family of educators, I'm developing a much deeper appreciation for the work that our teachers do with our children. I mean, in my experience, the most effective teachers are able to connect with their students. They're able to take difficult concepts and make them easier to understand. Our guest panelist today, Apollo Lupescu, has a knack for doing just that, both connecting with his audience as well as being able to break down complex financial concepts. Dr. Lupescu is a vice president at Dimensional Fund Advisors, one of the premier investment managers in the world. In his role, he is responsible for communicating Dimensional's academic foundations and investment beliefs to financial professionals and individual investors across the world. He is considered the secretary of explaining stuff because he excels at delivering thought-provoking presentations in a clear and understandable way. He has been with Dimensional for over 16 years, and prior to that, taught at the University of California and had his own consulting firm. Paulo received his PhD in economics and finance from UC Santa Barbara. He holds a BA in economics from Michigan State University. Go Spartans, where he competed and coached in water polo. Apollo, we're excited to have you here today with us, and we appreciate the time for you being with us today. We'll be having some difficulties. Oh, we're having a little trouble hearing you. Perhaps you're muted. Still can't hear you, sir.
Let's try. Maybe if we try unmuting him and then remuting him.
Okay.
Still no luck. Okay.
I don't know. Can you hear me now?
Yeah,
Yes, there we go.
there you go. Apologize for the
All right, does it
technical.
work?
Yes.
Does it work now, or is it? Can you hear me?
Yes, we're with you.
Finally. Sorry about that. Hey, thank you so much for the invitation, and thanks to everybody for attending. And it is actually a very interesting time because there's so much going on, and maybe I'll just for a few minutes just start with some of my thoughts and comments around what's going on right now. Try to give you some perspectives, and then I'd love to have a more interactive Q&A sessions to answer questions that are top of mind for all of you. And to begin with, I'll start with just something that is quite obvious, that what we're dealing with right now is quite different. It's not something that we've been part of in my lifetime. I mean, Joe was talking about having to homeschool kids. My kids have been home for about 5 weeks now, and not sending them to school for such a long time. It's never happened in my life. Walking outside and seeing all the restaurants closed and all the businesses closed, again, it's never happened in my lifetime. So it does feel really strange. On top of that, we have this health situation, which is real. I've had very close family members who have had the coronavirus and the COVID-19, and it is scary because we all have family members who are in danger from this virus. So all in all, it's compounded to be a really interesting time. And what I'll start with is to maybe kind of delineate between two things that are often put together, but they're not quite the same, which is the stock market and what's going on in the stock market right now versus what's going on in the economy. They're certainly related, and there are some lessons that we can learn. And at the same time, there is a difference between the stock market and the economy. So let's start with, what is going on in the economy first, and what makes this a bit of a different time. Typically when we have an economic contraction, there's something called a demand side shock. And what it means is that in the US economy, there are three categories, groups that generate economic activity. You have consumers, which is the largest chunk, and they buy things, goods and services. You have companies buying things, and you have the government buying things. And every once in a while, on average, once every 10 years, roughly speaking, one of these groups, particularly the consumers, they don't spend as much, either because unemployment becomes higher or there's something that doesn't go right, and consumers don't spend as much. And because they don't spend as much, companies don't produce as much. And that leads to an economic contraction. And we see that, as I said, once every 10 years. And the way that he normally addresses it is, well, let's get the consumers to spend more. And maybe there's a tax cut or some incentives that consumers get. And eventually, as they get the money, they spend more, companies produce more, and the economy rebounds. That's a typical problem with the economy, is a demand side problem where the consumers or the government or companies are not spending enough. What we're seeing today is not only a demand side problem, but also there is a supply side crisis. And it is a crisis on the supply side because even if consumers want to spend money, And you heard that everybody got a stimulus check. It's not really a stimulus check because there's nothing to stimulate. Even if you got that money, you're trying to spend it, you can't, because restaurants are closed and shops are closed, and workers are stuck at home. So we have a supply side problem because companies are just, the economy is not producing because we're all sheltered at home. So whereas we can see that every 10 years or so we have a demand side crisis, it's not often that we see a demand and a supply side crisis. And in fact, as I've looked through the economic history books, what I found is that there are 3 instances where I think we can draw some relevant comparisons to what's going on right now. And the first one, interestingly enough, happened almost exactly 100 years ago. And what happened 100 years ago is that we had the Spanish flu. It was in 1919 to 1920. And during the Spanish flu, we can argue that the world was different. That's 100 years ago. How can you compare back then with today? Certainly some differences. And interestingly also, when it comes to medicine, even with all the medicine that we have, the treatment tends to be similar like it was back then. Stay home and take care of yourself, because there's not much that you can do. We didn't have a vaccine back then. We don't have one now. But what's even more interesting to me is the way that the economy dealt with it and the government dealt with it. And what I mean by that, if you look back then, cities, pretty much like today, in order to protect their citizens, they basically went into lockdowns. Social distancing, what we think today is like, wow, we've never seen something like this. We haven't, but our grandparents have in 1919. It was exactly like this. Churches, schools, all indoor meetings, and not just in one city, but pretty much across the country. If you looked across the country, you saw that it's everywhere that you see these quarantines. People were required to wear masks, and there was a police force in there to enforce it. You couldn't get on the trolley unless you had a mask. So it's very, very similar. Even the directions, what to do to stay safe. Go wash your hands. Don't get in the crowds. If you sneeze in your elbow and handkerchief, which was the norm back then. So to me, what's really remarkable is to see that we have gone through exactly the same thing 100 years ago. And there was a paper recently published by 2 economists from the Fed and a PhD from MIT that looked at what was the economics of the crisis. And what they found is something very clear. You have to take care of the health crisis first before you can address the economic one. And it's so fascinating to see that cities that actually reacted early and they had a longer lockdown, at the back end, they tended to be better off from an economic perspective relative to cities that acted late and they were not shut down as long. So in the short end, the cities were basically locked down and closed for about 60 days. At the long end, 120 days. The average was exactly 3 months. And what you saw is that the debate that we have today, which is economy versus health, it's not really a debate. It turns out that until you address the health, you're not going to have a good economy, because even if you open it up and people are not comfortable going outside and spending and doing their normal things, it doesn't matter that it's open. You're just not going to have a good economy. And that's what the paper found, is that the cities that took care of it, people had confidence that this is taken care of, then that's when they recovered. And again, we look today and say, well, it's so different what we have today, technology-wise. Of course it's different. But it's also fascinating to see the way they dealt with it back then. They didn't have internet, but you can phone in an order, stay at home and phone in an order. They didn't have Netflix, but they have these players, whatever they were, where the dogs are staring into it. And then you can get entertainment at home when you can't leave your house. And by the way, there was no Zoom. But back then, all you needed was like a telephone. People who are in quarantine are not isolated if they have a bell telephone. So it is interesting to see that not that a history repeats itself precisely, but a lot of the things that we think are so striking and unprecedented, they happened pretty much exactly like this 100 years ago. It's also interesting to see what happened afterwards from an economic perspective. And we don't have really good data to show you, but I can tell you anecdotally that the following decade, once the flu was over, was not considered to be a disaster. In fact, it has a pretty striking name, the Roaring 20s. It was an incredibly vibrant decade, and soon enough, people went back to doing the same things they did. They went for beverage until prohibition came along, and then manufacturing was the golden era when you start doing, mass production, and cities came back to life, very vibrant. And as a whole, the decade isn't known for dread and pain, but rather it was a pretty uplifting time. So we had something like this 100 years ago, almost identical in some ways to what we're going through right now. Back then, over 500,000 Americans died, 50 million people around the world. So it is something that at least we can look and draw some lessons from there. The second period when we saw a similar supply and demand crisis, it was during World War II. And in those days, 11% of the U.S. workforce was pulled out and to participate in the war effort. So 11% of the people were not there to produce things, and it's also as a great lesson how we dealt with it as a society. And what we found is that women can pretty much do exactly the same jobs that the men did. And then you had Rosie the Riveter, and it's a movement that, in my opinion, started back then, and ever since has been inching in that direction to really have equality between men and women. So, but to me, it started back in those days, realizing that anybody can do, the woman can absolutely do any job. But there's another big lesson that we learned from those days, which is that in a free market, companies will find a way to make money in whatever state of the world we're in. And back then, if they couldn't make cars, guess what they made? Tanks. If they couldn't sell toys, they might have made bullets. And that's what we see today. You have distilleries, instead of brewing spirits, they're doing hand sanitizer. Ford and GM are repurposing assembly lines to make ventilators and face masks. So that spirit is with us today. And even though CEOs might be working in their pajamas from home, they still have the same goal in mind. How do I get this company back on track to make money? And that is with us today, and it was back then. And one more cautionary tale. Whenever you look in the situation and seeing it's dire, put some perspective. Back in those days, in 1937, the market dropped by almost as much as the Great Financial Crisis. And that did not look good. Hitler was in power. You had the huge market drop. We had a rebound in 38, but 39, 40, and 41, by the time U.S. entered the war, was terrible. 4 out of the last 5 years in the market, you would have lost money. And the average was a negative 7.5% loss per year for the previous 5 years. So imagine yourself, you're sitting in a living room, it's dimly lit, it's at night, and you're listening to the radio blaring all the bad news, and the US is entering the war, and you look out there and say, family members and friends and neighbors are leaving and maybe not coming back from the war, and millions of people are dying, cities are being destroyed, you've lost money 4 out of the last 5 years. How would you have felt as an investor? My guess is it would have been terrifying, absolutely terrifying as an investor. And so, well, that's the last thing I want to do is touch the stock market because dark days are ahead. You would have been 100% right. Those are really dark days. In fact, the darkest days of our parents' generation. What's remarkable is that during those years of war, the darkest days of our parents' generation, the U.S. stock market grew on average of over 20% per year during the full years of the war. These are the darkest days when everything was supposed to be doom and gloom. Somehow the market went up, and a dollar invested at the beginning of the war would have pretty much doubled by the end of the war. So it is a caution that things might look dark, but again, come back to this idea: these companies will find a way to make money in whatever state of the world we're in. So that's the second time that we saw this supply and demand crisis. And the third time that we saw it was in 1973. There was a conflict in the Middle East. We're not directly involved, but just to show their displeasure with the U.S. policy, the Organization of Petroleum Exporting Countries, OPEC as we know it, decided to put an oil embargo against the U.S. And soon enough, what you found is that there were shortages. there were gas shortages, and the whole economy relies on this commodity. We can't go to work. We can't take our kids to school. We can't have an economy if we don't have the energy. And that was really terrible. And you know, you asked I was talking to my in-laws about the time when they were spending hours in these cars waiting to gas up, and it was panic. It was terrifying. And again, what's the lesson for today? We had a supply and a demand shock back then because the economy went into a pretty deep recession. But the lesson is that we learned and we changed. One of the realizations that we can't have the gas guzzlers of the 70s, and there was a law put in place requiring better fuel efficiency, which is with us today. But also more importantly, and I think it's something that's absolutely possible. Back then, we realized that when you look at oil as a commodity, it's not just about making money. It's a national security issue. And over the years, we have tried to become energy independent. Well, today, the US is the largest oil producer in the world. From the time where we could not function as an economy, now we're the largest producer, actually getting more oil out there than Saudi Arabia, Russia, and all the other countries. And to me, the reason that I mentioned that is what's happening right now is companies realizing that the freewheeling supply chain that comes from all over the world might not be as reliable as they thought. But more importantly, there is a national security component. And we might look at this moment as the trigger that provided the rebirth of American manufacturing, because we realized that we actually need to start producing something within the borders of this country rather than everything flowing from some other place. So to me, these are the three periods in time, lessons that we can draw from history to guide us. And in every case, it seems that there is a change that will be made in some way. And in every case, it seems that the markets were resilient because companies were resilient, and companies were resilient because mankind is resilient. So that's on the economic side. Just give you some perspectives that this feels absolutely different, and it is in many ways. And there are only a few times that we can draw some parallels, but when we do look back, it seems that it wasn't as bad. And maybe I'll go back to showing one more thing that I think it's interesting is that in back in those days, you know, 73, for example, we also learned that it is nice to have better efficiency for cars, and that would help not only us but the environment. And what I realized is that we are lucky enough, at least I feel like I'm lucky enough, I'm blessed enough to be at home, safe with a job. And there are some things about this quarantine that I love. I love spending time with the family, but I also love how the neighborhood where I live in Los Angeles has been reshaped by everybody being home. There are children riding on bikes. There are no cars. And in fact, I walked the dog the other day, and I could see a range of mountains that I had never seen from my neighborhood, just because there's such little pollution. And in fact, this is LA Metro last year in terms of pollution. It's terrible. And this is what it is today. It was cut by 50%. So maybe one of the legacies is that it is nice to breathe fresh air. It is nice not to be caught in the race of always take the kids to practice and run. And there is something nice about what we're going through. And it's quite possible that soon enough, we'll go back to the old lifestyle, all the things that we had like a few months ago. And we'll remember this with some level of nostalgia if we all can come through this in an okay manner. So that's what's happening on the economy side. On the market side, what we are seeing is that there's a lot more uncertainty when it comes to the main source of value for the market. The market is reflecting on the value of various companies. There are about 3,000 companies in the U.S. economy, and usually we use something like the Dow Jones with 30 companies, or more broadly the S&P, to get a sense of not any one company by itself, but when you put them all together, how is their value changing? Well, the value of a company is derived from the fact that if you buy a share of stock, you become part owner in that company. And any business owner is entitled to part of the profits that the company makes. So the value of any company, the intrinsic value, comes from what am I expecting to receive if I buy this business, which is what you do if you buy a share of Apple or Google, Exxon, McDonald's. You become part owner and you are entitled to part of the profits. So you have to figure out, what do I pay today and what money am I going to get in the future? And the value therefore is derived from these profits. And what we've seen is that as the coronavirus unfolded, obviously the profits dropped, and so did the value of these companies. And that's why we saw the market drop. It's a sign that the markets are working well. It's reflecting that, hey, maybe these airlines are not worth today as much as I thought they were worth at the end of last year. That's exactly why the market has dropped. And it's also moving around more because it's harder for investors to gauge what will be the profits. There is no playbook for a pandemic in our lifetime. So, and even companies have stopped offering guidance on their earnings. So investors don't have a really easy time to figure out a model of how might this play out. And that's why you have bigger swings. But all these are signs of a well-functioning market. And to kind of wrap up the intro comments, I mentioned to you that the stock market and the economy, they are not the same thing. And you should be careful not to confuse them. A lot of times in the media, they're kind of hand in hand. Well, the stock market's doing well, the economy's doing well. They're not the same. What I mean by that, think of the economy as a frame into a movie reel. So when you have a movie reel, it has tons of frames. The economy today is a snapshot. What's going on today with unemployment, economic production, profits for companies, that is a snapshot today. The stock market is the entire movie. You play it for a lot longer. Why is that? Because when you buy a company, a share into a company, you are paying not only for profits that you will get this year, next year, maybe the year after, but a very, very long time, 10, 20, 30, 40, 90, 100 years. And I'm not exaggerating. Exxon has been paying profits to shareholders since 1911. If you owned a piece of Exxon in 1911, for the past 100+ years, you would have gotten paid every year. So it's a very long-term proposition. And that's what the stock market is looking at. Not the next year, not the next 6 months, but the next 5, 10, 15, 20, 30, 40 years. So in that respect, if you're looking at the next 50 years, how much do the next 5 months matter, or the next year? In the big scheme, it doesn't matter that much because it's a movie being played for a much longer time. And that's the difference. And that's why sometimes you see the economy looking really bleak, but then on the other hand, you see the stock market's taken off because the market's not only concerned with the next 6 months, but the next 60 months or 60 years. And it's an important distinction to make. Don't look at the economy and the stock market to be the same. Quite often you see that, hey, if the economy is doing well, it's quite possible that the stock market might also be doing well because things are looking good, but they don't have to move in lockstep at all. So with that, those are the few comments that I wanted to make up front, and I'd really be curious to hear more from Joe and Jeremy if there are any questions either they have or coming in through the chat box.
Thank you, Paulo. Appreciate that. I know you touched upon, you must touch upon separating, the markets from the economy. And, I guess a lot of questions, that we have or, clients have is like, well, it seems like there's still a lot of bad news out there. Like there's still a lot of uncertainty. We don't know where things are going, how this is going to play out. Like, why is the market going up? When there's still all that uncertainty out there.
Yeah. And that's a really good illustration of the principle. I think what the market's looking is again, it's saying that there is some pain over the next 1, 2, 3, maybe 6 quarters. And we had an economist from Stanford, kind of talking about the economy will slowly rebound over the next a few months to the end of the year. It would still be a little below where it was a year ago, but it would take about 6 quarters until it rebounds. So it could be that there are some dark days ahead. And what the market's saying, this can last anywhere from a month, 2 months, 3 months. Let's say it takes a whole year before we get the vaccine, or 2 years. What you find is that even in this period, the economy will function and companies will make money. But again, it's a matter of seeing the prospects after this, because that's what the market is pricing, not only the dark days that are strictly ahead of us, but the bright days afterwards. And to see that in action is probably the best time is to look at 2008, 2009. 2008 was a bad economic year, but 2009 was the worst year of the economic downturn. So if you're at the beginning of 2009 thinking that this is going to be a bad one for the economy, you would have been absolutely right. It was the worst year of the economic downturn, no doubt about it. The thing is that in 2009, the US stock market did not go down. In fact, it went up by 26% that one year, even though things look really, really dark. And that was because what the market was pricing in is saying, okay, there will be a period of pain, but what we see is that after this pain, we have found a way out, and this will take some time to clean up. But once it cleans up, you will see brighter days. So that's what the market was pricing, and that's why today, even though there are all these negative news, the market is absolutely looking beyond them, because you're buying profits for years and years and years down the road. And that's why you're seeing that even with negative news, it's absolutely okay. It's absolutely fine for the market to go up. It's just the markets every day, these market participants are pricing in and saying, how long can this possibly last? And I can tell you the level of sophistication and models and data that they have are mind-boggling. So they're really incorporating all the news that you hear on TV or on the internet, but they also are looking at much more sophisticated data models because there's so much money at play.
Right. And I mean, it tends to seem like also as good news comes out about the virus and, vaccinations or whatnot, that, people are focusing maybe more on that than actually really the underlying fundamentals of companies and how they're going to be affected. Is that danger as far as you're concerned?
No, I mean, I think that what is important for everybody to understand is that the stock market is such a competitive place, and everybody has some level of information. And because it's so competitive, and just to give you an idea how competitive it is, there are more professionally managed mutual funds in the US than stocks trading on the market. It is incredibly competitive. And everybody in this marketplace is trying to get a hold of some piece of data, some piece of information that would give them a competitive edge. And because there's so much money at play, they are hiring the smartest people. They have the data. I'll give an example. This is not related to what's going on right now, but it kind of gives you a flavor. There is a company, a vendor out there who's saying, hey, listen, if you want to understand Walmart better, what we have is an army of mini satellites into space. And what they do is they snap pictures of Walmart parking lots and they count the number of cars. And an investment manager would buy the data to kind of get a sense, would the sales be up or down this quarter? They have detectives snapping pictures of people's cards. That's the level of data that investment managers have. So they're not like watching the news and saying, "Hey, I'm going to watch, CNN or Fox News, whatever you watch, and say, let me make a trade based on that." No, or there's a vaccine. They have data that is well beyond what any one of us would do it. The thing is, they don't actually talk about it because they're trying to make money off the data, and that's the difference. You don't see it, but I can tell you right now, the level of sophistication and data crunching that these guys have in terms of the vaccines, who's doing them, they know all these things, and they pay big bucks because that's what gives them a competitive edge in the market. And that's one reason that none of us who are individual investors, who are just retail and just have other jobs, none of us should ever touch the stock market unless we do it for fun, because you are at a disadvantage. There are people out there spending so much money to get data that you just don't have access to because it's too expensive, and then you're trying to compete with them. You will be at a disadvantage, unfortunately.
Thank you.
So Apollo, we've been monitoring the questions here. They've really started to pour in. There's a couple veins here in these questions. So I'm going to start with one. Question is Dimensional doing anything different given the current financial market situation? And how do you think that Dimensional portfolio managers are able to stand out and distinguish themselves compared to the competition in this environment?
That's a really good question. So let me touch on that question, which is, you know, what's dimensional doing and how do we, what are we trying to do? The first thing is that there are two very distinct ways of investing money. One is in which you have, you know, expensive mutual funds who are saying that our value proposition is to look at the market, and let's say this is the entire stock market and everything that's out there, and we want to just select what we think is the next big winner. You know, what's the one thing that's going to shoot the lights out, and then really place some concentrated bets onto those sectors or companies. And you know, we heard at the beginning of the year quite often, like oil is so cheap. Absolutely, it's a no-brainer. Let's go into oil. Let's place the big bets there. Zoom, this technology company, whatever the case might be. And what we found is that in this competitive place, there are two things that happen. One is by the time you get around to buying some of these companies, they become so expensive that they're not worth the trouble. They're just too expensive. They're not a good deal anymore. And secondly is that for an investor, if you're placing these big bets, you can absolutely strike it big. And it's possible that, say, oil might just go through the roof and just do really well. It's also possible that it can go to the other extreme. And the more you concentrate, the more you can reach these huge extremes. So what Dimensional has been trying to do is actually have a different value proposition and say, we absolutely want to have these, whatever we think it's the next best thing, but we want to put it in a way that not any one investor, not any one investment or sector would ever meaningfully impact the portfolio, because what we want to do is ultimately shrink the range of what can happen with your money. You know, in other words, we might not be able to deliver that one amazing investment that shut the lights out and made a lot of money. We also avoid just, you know, making a really bad call and then losing a lot of your money. And in this scenario, I think we want to give investors over 12,000 companies in 40 different stock markets, because that way, you know, the chances of you kind of going to zero are low or zero, because what are the chances that 12,000 companies, every single meaningful enterprise in the world, disappears at the same time? Well, chances are we all have much bigger problems like max time or something. And so the first thing that we try to do is make sure that we don't place bets with your money, but rather grow your assets in a much more responsible way. And we never have to go back and say, hey, I'm sorry that we put so much money into this one investment, it didn't work out. That's not what we do. So in that vein, one of the things that we're doing different today is be very precise between the type of investments that we give advisors. And there are two main kinds of investments out there. One is what I mentioned, stocks. And stocks have given investors something in the order of 9 to 10% per year. And we want to give that funds that have very, very clear delineation in stocks only. So the advisors know what they put into your portfolio, as opposed to a manager that might have all kinds of other crap in there. But we also know that stocks have been very, very choppy. It's a roller coaster. That's actually a pretty good analogy. It's a roller coaster, and it's a rewarding one. The ride has been very rewarding. $1 invested in 1926 when my dad was born. And by the way, this is a book that we have called the Matrix book. $1 invested in 1926 would have grown to about $7,000 by the end of by the time my dad turned 92. He's 93 today. So it's a very rewarding ride. The price of admission is just knowing it's choppy. But we do give investors funds that are very specific to just stocks. So if you need stocks, if you need growth in your portfolio, we have different funds that are very, very precise every day. And I'll come back to what we do different today in this. But we also wanted to give investors and advisors like Joe and Jeremy and Sax, we wanted to give a different category of investments that are, they're called bonds. And what it is, a bond is a contract where you enter a contract with a government or a corporation that for a specified period of time, you receive a fixed interest rate, and at the back end, you get your principal back. And let's say you do it with the US government, which has never missed an interest payment or a principal repayment. You do it for 30 days. That's called a 30-day US Treasury bill. And in that case, over the past 93 years, there has never been a negative calendar year when you would have lost money. So the idea is that we want to give, the first thing that we do is we want to be very precise in what we give advisors. We want to either give them stock funds that have ownership in companies, or we want to have them bonds, which are a fixed interest. It's like a loan that you know exactly how much you make. Now, because there's more stability in this, you don't make as much, so it's 3 to 4% on average that you earn over the same time frame. Now, to be sure, a dollar invested in the safety of T-bills, you might think, well, if 9-10% is $7,000, how much can it be at 3-4%? It turns out that the Matrix book also gives us the answer. It's a whopping $21. So we want to. That's the reason that we want to be very clear in the way that we deliver the funds. Every day, pay attention that we don't put bonds in stocks, and we don't put stocks into bond funds, because we don't want to create any more risk. So what is it that we do specifically at this point at Dimensional? The big thing that we can do is preserve this consistency between the funds, so the advisor knows exactly what they have in your portfolios, but more so implement paying attention to the world. We have a business model that is unique in the industry. We don't work directly with retail investors. So if somebody has, let's say you have $1 million, $2 million, whatever number of money, as and you say, I like to buy dimensional funds, they're only available to either large pension plans or certain financial advisors in the country. We don't ever pay the financial advisor. It's completely a fiduciary relationship. They just think that these funds fit the bill. But what's interesting is that because we have the relationship, and we've worked with Sax for many, many years, what we're doing is connecting with advisors that have a very institutional strategic mindset. Not somebody who gets carried away with emotion, not somebody who's just forecasting and placing bets. And the benefit of that is that in markets when everybody is selling, the advisors we work with actually have a bit of a different approach. And I'll give you the example of 2008, 2009. When the stocks were dropping and dropping and the bonds were going up, what the advisors were doing, instead of selling in panic, they were buying stocks so they can get back to the right proportion. That is called rebalancing. And it turns out that everybody in those days was basically selling in panic. And because we are so careful onto who we work with, when all these managers were doing the rapid fire sales, guess who was buying on the other side? It was Dimensional, because the advisors were keeping the clients disciplined, and they were rebalancing. So to me, what we're trying to do in times like this is be incredibly careful not to get carried away with everybody who's selling on emotion or panic, and be the smart people who look at it and saying, well, buy when there's blood on the streets, be fearful when others are greedy, and greedy when others are fearful. And we couldn't do this if it wasn't for the advisor community with whom we work. So a lot of what we do right now, it's specific to these times of crisis where we pay attention to trading, we pay attention to a lot of activities, but so much of it is because we have this incredible relationship with this select network of fee-only financial advisors who have, with whom we have an alignment, and I think it's been an incredibly mutually beneficial relationship.
Joe, I think you might be muted.
I started hearing some noise in the background from the kids, so I want to make sure I wasn't distracted.
I have a dog here, so don't feel bad if you hear
likewise.
Bark.
So, kind of what I'm hearing you say is that, asset allocation seems to be the most important driver, right? Your allocation for these stocks and bonds, which I think we know. I mean, for us at Sax, I mean, we generally start any investment plan with some kind of financial plan, and determining that allocation is really dependent on each individual situation and where they're at. And that's a long-term, right? A long-term investment. And what is a long-term investment? We're looking at 1, 3, 5, 10, or is it 20, 30 years? How do you're talking about from 1926 till now, or it's a long time frame, and hard to hang on for that long sometimes.
Right. And the thing is that what's interesting about the system, and I'll touch on one more thing that Dimensional is doing. What's interesting about this system is that it's not designed to offer guarantees. It's not built around the idea of, well, we'll just give you any guarantees. It's much more of understanding the odds of investing, and it's the same as, you know, I used to smoke and not eat healthy and not work out, and at some point I changed and I'm a lot healthier. I quit smoking. I work out every once in a while. Does that guarantee me a longer lasting, healthier life? It doesn't. What it does is it improves the odds, it improves the tilts. So when you look at this idea of stocks versus bonds, it's not a guarantee that every day the stocks are going to beat bonds. In fact, on an annual basis, what you see is about 25% of the time, the bonds will beat stocks. So 1 in 4 years, you have a chance of seeing the bonds outperforming. And that's okay, because when there are years when the stock market's dropping, it's fine for these bonds to outperform and have better results than stocks. The thing that I want to mention is that it's the consistency and not only the consistency in philosophy, but the consistency in what the advisors deliver. One of the things that Dimensional has been trying to do is look in the stock market and try to delineate between the different types of investments. And if you look at the different types of investments, well, what I mean by that, if this box is the entire stock market, we have been analyzing and see how do you parse out the market in different ways that has economic intuition, but also can deliver better results for investors. And one of the things that we found, and this came out of work that was done at University of Chicago, was that large companies, the well-established Jumbotron, Apple, Google, McDonald's, Coca-Cola, that's what you see in the S&P 500 or the Dow Jones. They have a certain characteristic, but there's another category of stocks that are smaller companies, which are still part of the U.S. market, but they're not as big. So you have, like McDonald's, but you also have Shake Shack. You have Bank of America, but you also have Bank of Hawaii. So all these companies that are smaller, they're part of the U.S. market. It turns out that they carry a little bit more uncertainty, without a doubt. Historically, particularly in times of a downturn, they do carry more uncertainty. There's no doubt about it. They also have more potential. Like, it's nice to look at McDonald's or Amazon, but how easy is it for those companies to double in price, whereas smaller companies can grow a lot more? And the way you see that is if you look over the same time period, the $7,000 in growth from a large company over the same time frame invested in small would have grown to about 27,000. So a lot more significant growth, knowing that there are periods like this when small caps might actually dip more than large caps, which is fine, because that's what you expect. There's more uncertainty, but also more room to grow. And then in the 80s, the question was, what about all the large and what about all the small companies? Are they the same? And what it matters is something I mentioned earlier, the price at which you buy them. And the lower price companies are value stocks. That means that if you want to buy $1 of earnings or cash flows or dividend, any accounting fundamental, if you pay a low price, that's a value company. And historically, they have outperformed the more expensive counterparts called growth stocks. So knowing that small beats large and value beats growth, the one asset class, the one part of the market, which is called an asset class, that would give you the biggest bang for the buck would be small value. And over the same time frame, the same dollar would have grown to about $72,000. So you can go from 7,000 to 27 to 72. The more you emphasize small and the more you emphasize value. So one of the things that we're doing at Dimensional every day, particularly in times like this when there's a lot of movement, is pay attention every day to see what stocks belong in each category. So if you have a stock that was small, and then the price just shut through the roof, became expensive, and now it's a large company, well, we have to be able to deliver just the small cap. So we have to every day pay attention to have just the right stocks. And in times like this, what we see is there's a tremendous movement and there's a lot of balancing act to be done in terms of how do you buy and sell to maintain the purity of any group of stocks that we want to deliver to Sax and the advisor community, because that's, as I said, that is a fundamental value proposition. When they choose a fund, they know exactly what's in there, no surprises. And a lot of other managers, that's what the problem is. They're kind of running all over the place, and quite often you have no idea what's in there. And I think that's one of the things that we're trying to do, is be very consistent and pure. But you mentioned I don't have 90 years. It's absolutely true. And even if you look at small outperformance or value outperformance, it's there, but on an annual basis, not even a quarterly, but when you look on an annual basis, about 60% of the time, you see that indeed, yes, small outperforms, which means that 40% don't expect it because you won't be there. And 40% is not trivial at all. And even if you go to 5 years, what you see is that small caps outperform roughly about 70% of the time, but even then 30% of the time, it's not there. So again, the price of admission is knowing that that's not going to be there every day. And because of that, what we also try to do is deliver both funds that are very specific to each part of the market, but also comprehensive funds that cover every part of the market. So there's a fund that would have both large and small, but instead of looking at the natural way you spend money in the market, if you were to buy like a market portfolio with just the right proportion, so think of an ice cube tray that is leveled, where every ice is the right amount of water, that would be the market if it's leveled. So you'd spend $90 on large and 10 on small. We're tilting this and we're taking some water from large companies, and instead of 90, maybe we just buy 75, and then we boost the small to 25. So what we're trying to do is be very precise, give advisors either individual pieces that they can assemble or something that is comprehensive that will not miss on large or growth in case those do better.
Okay, thank you.
So coming out, assuming we're going to be coming out and there eventually will be a recovery, I mean, are there companies or sectors that might be well positioned to, better recover coming out of the crisis, or should we just buy what's already gone down?
I think that in my opinion, one of the things that you should consider and talk to your advisor is whether or not your portfolio is at the right level. So to me, that the buy something that's gone down, I think a lot of times it makes sense in the context of going back to the right proportion between stocks and bonds. And Joe mentioned the plan. That's the most important thing. Look at it for your plan, for your circumstances. What was the right allocation between stocks and bonds? And what you see is that when the stocks drop, then you want to buy them, not necessarily because you're making a forecast about where they might be going. They're going up or down, because nobody really knows that. But what you want to do is buy them so the proportion is where it should be. And what the benefit there is that when there is a rebound in the economy and the market, then the stock market goes up, you're not too light on stocks, and you can catch up and actually join the recovery with the right proportion of stocks in your portfolio. So to me, that's something that should be done. But if you're looking for a sector just to kind of say, I think this is going to do well, what is it that it will be better positioned going down? Everybody's looking for this. Everybody's looking for this. Everybody has the same questions. It's probably the most common question that I get at these events. What should I be doing now? What should I be buying now? And unfortunately, what is obvious has already gone up in price. So you'd be paying quite a bit right now, which I'm not sure that makes it a good buy. And secondly, as I said, if you're going to put a lot of money into one area, you got to be careful because you could get hurt. I remember at the beginning of the year when this whole thing, just before this thing was going down, and people were saying that there was a meeting in March between Russia and Saudi Arabia, and they had a disagreement, and they didn't come to an agreement, and the oil tanked. And there are so many people who basically said, I'm going to jump all over this because it's a no-brainer. I can't lose money on this. The oil is so cheap. Well, guess what? Last week the price went negative. So it's not always that clear that even
Right.
something that makes a lot of sense is going to play out the way you do. And if you end up putting a lot of money into that, you could get burned. And it's basically the individuals, investors who are betting on oil who drove the market down, because there was a technicality that made it happen the way it did. But nevertheless, I would be careful chasing fads, because that's not what you need. What you need is a financial plan. And a better question is, how do I get from point A to point B with the least amount of risk, rather than say, I'm willing to take whatever risk. You know, you might not need to. You might not need to shoot the lights out. You might need to actually be more prudent about your money than think, let me try to make a killing now.
Right. Gotcha. So we're running a little short on time. I don't know, Derek, if there was any other additional questions. Maybe we have time for one quick more before we get some final thoughts from Apollo and close this thing up, wrap it up.
Yeah, the last one I'm really seeing here, a little bit about the current unemployment rate and the effect of stimulus money being pumped into the markets. And you could talk one quick broadly, broadly. I know that's a big, we could do a whole hour discussion on just that, but just,
Right.
what that impact might have and how you feel about it.
So my feeling is I kind of mentioned earlier, I think that the word stimulus is not the right one, because there's nothing to stimulate. You can give people money, go spend it where? Everything's closed. The economy is not producing. Everybody's stuck at home. So it's not really a stimulus package as much as, to me, it's what I would call a liquidity package. Is that right now, a lot of people and a lot of businesses, particularly small businesses, are at a point where if they can get through the next few weeks, they would be able to come out at the back end of this quite all right, and not suffer tremendous pain. So it's a matter of getting everybody through to the finish line over the next few weeks. So it's not a matter of months and years. It's just another few weeks, but we need to somehow do this. And every economist that I've talked to, and we had Professor Lazier from Stanford not too long ago, everybody was saying the goals of these interventions are absolutely the right ones. I know that a lot of people have maybe a point of view that has to do with their opinion of the government. From an economic perspective, I can tell you that this is the right thing to do. You have people who need to get by and need to get through this, and then when the economy reopens, they'll be able to do it. You have to get back into what they did. You have small businesses, our main streets, who would be able to go back and reopen if they can get through the next few weeks. It's just the problem is that if they get no help, if there's nothing there, they would all have to shut down and close as a business. And reopening a business, hiring people again, that's a nightmare of a situation. Whereas this is just getting them a little push. And I know it's not pleasant, but it is something that, in my opinion, it's necessary. And the way I looked at it is more like, when the house is on fire, don't worry about getting the carpet wet. We'll deal with that later. Right now, let's just put out the fire, and we'll deal with cleanup and the carpet later. And I think that's the main thing, is that right now we do need to put the fire out and then go through the cleanup. It's just that if you don't touch the fire and say, well, I'm not going to do anything about it because the carpet might get wet, well, the whole house will burn down, and that will be a lot worse. So there are two unpleasant options that you have, and you have to choose the least bad out of the two. And to me, the least bad of the two is to support and move this. And every economist that I've talked to, everybody from pure data perspective, not political ideology, but pure data perspective, is saying that you need to have something like this to get past the hump. There's a period where, whether it's psychology or something else, panic, it will impact the market. But if you can get through this, it will be better than not having done anything. And the last example I'll give you, there's certain lending that happens in the economy, and most of us are not ever familiar with it. It's a very short-term lending over a week or two or month, where a company, until they get paid themselves, they need to make payroll, and they need to have short-term money that they need to spend. That is called commercial paper. Most people never heard of commercial paper because it's not, unless you're a business owner who uses it, it's not something that it's a pretty, it's in a corner of the financial market, but it's a hugely important part of the financial markets. Well, it turns out that at the beginning of this crisis, that very important part, because it's the grease, it's the oil that makes this run smoothly, the economy. It started to freeze up because nobody wanted to lend. Well, what if you're not around next week and I might not get my money back? And with that type of pipeline frozen, it would have been a terrible situation for the economy, and it could have snowballed into something terribly, but it was all because of the panic and the fear. So in this case, the Fed stepped in and said, listen, if you give a loan that is not performing, then we'll buy it from you. And that gave people confidence to go back and lend money. Now, if the Fed hadn't done this, and there was no cost to the Fed, it was just a statement that they made, but that particular statement really helped just soothe the anxiety, and the market returned and is pretty much back to where it should be. So it's getting past this hump. And I think that in my opinion, it's better to have an intervention than, and in fact, it's probably better to overdo it a bit, just because the situation is pretty dire.
Great.
Yeah, so I think that about wraps it up for us. I don't know if I don't know if you have any final thoughts, but Jeremy, I don't know if you have. Go ahead.
No, I think we're good.
Yeah, I mean, I actually, like, my final thoughts is that we've been talking about the market and the economy and all these things that are certainly interesting and part of our life. What I think is ultimately the most important aspect of this crisis is for all of us, and for you and the families in the community, to just be healthy and stay safe. And I wish everybody just be safe and healthy. And on that note, it's an amazing debt of gratitude that we all have to the folks who are going there every day to help us be at home and be safe, and particularly the healthcare workers, because they're the heroes of today. They're the firefighters of 9/11. They're the folks who go to work every day knowing the risk to their own health and to their families, and they're just putting it on the line for us. So, a huge debt of gratitude, and thanks to Sax for the partnership, and thanks to all of you for the trust that you placed in Dimensional Funds. And we're here to be with you in good times as well as challenging markets. And we're healthy. We're 100% invested in the market. We are actively participating in the market, even though we work 100% from home. And we'll continue to work with Sax and help them, help you achieve your financial goals. So thank you for the trust, and thank you for the time this afternoon.
Thank you. Just to reiterate, I just want to close by saying that I think it's crucial from my perspective to remember that these once in a lifetime crises, they also present us with historic opportunities. And I found this to be true not only from an investment perspective, and I think we've kind of had talked about this a little bit, but also on a professional and a personal level as well. This disruption has allowed me to forge deeper relationships with our clients, and as challenging as it is at sometimes, it's given me the opportunity to spend unprecedented amount of time with my family that I wouldn't otherwise be able to do. So once again, Apollo, thank you for spending time with us. Thank you everyone out there for joining us today. Please know that the Sax team is here for you. We're working around the clock as well. We're still fully functional. If you have any questions about your investments or want to discuss your financial planning needs, please reach out to us. We're here to help you. We're all in this together, and we'll get through it together. Thank you, and have a great night.
Bye-bye.